The Fed just lit the fuse for a major rally.
The Melee administration has done 3 adjustments, and this marks the beginning of the 3rd one. So they did a large fiscal adjustment, a large monetary adjustment.
One scenario he said he was modeling or thinking about is one where these big tariffs stay and the average tariff in the U.S.
Bessent was asked about how China's Commerce Ministry called these tariffs a joke because of how high they are.
Markets continue to whipsaw. Just on Monday, the Dow gained 300 points after Trump floated auto tariff exemptions. But what really is happening here is that the Fed just flipped to signal they're going to come to our rescue, even if the zigzaggedy volatility madness a la Trump continues. And there are 2 scenarios that'll play out here. And once you understand both, you will know what to do with your portfolio. And perhaps you've noticed how the media keeps flip-flopping between recession fears and recovery optimism about 3 times a day. And after spending over a decade as an investor and analyzing these kind of market standoffs, I can tell you there is a clear pattern forming that most retail investors completely miss. You'll see exactly how to interpret Secretary Bessent's 3-legged stool strategy and the specific sectors poised to outperform in both high and low tariff scenarios. And can you imagine having that kind of clarity while everybody else is panicking over the latest headline? In the next few minutes, you will gain exactly that clarity to be a step ahead of everybody else. Now, Winston, my golden retriever, has, of course, done all the research here, so take the scenarios with a pinch of large golden retriever fur. And speaking of a large pinch of something, if you've ever wanted to actually consistently spot market opportunities before the crowd, then what I'm about to share with you will...
Yeah, guess what? Felix has a masterclass. Yeah, I can see that ad coming. Let's skip forward. Hang on. Where's the content?
How much will these tariffs push prices up? So how much inflation will they create and for how long? To understand that, you need to understand Secretary Bessent's approach. And he just explained this in a Bloomberg interview, and he was very clear. He said the current rates are maximum rates. Essentially, they're the opening bids in a Trump-style negotiation. I'm going to grab you by an ankle, I'm going to hang you out of the window and go, how do you like it out there? And the 90-day pause, it's deliberately designed as a negotiation window. So Bessent has literally told trading partners, bring your A game to the negotiation table. He's expecting to secure agreements in principle with numerous countries within this time frame, which suggests he's quite confident in the strategy. His core message to the markets, that's you and me, stay cool. He genuinely believes the situation is under control. You may disagree with that, but in fact, he suggests that market uncertainty has already peaked. Perhaps most importantly, Bessent emphasized that tariffs are just one part of what he calls a 3-legged stool strategy. And what are the other 2 legs? Tax policy is predicting significant cuts beyond just extending the existing ones, and deregulation. Both are expected later this year and should provide powerful market support.
Yeah, the whole tariffs for tax cuts is interesting, right? Because if tariffs go through, big if tariffs go through, that's going to increase the price of goods for everything, right? We understand basic economics here. If the manufacturing costs, which include tariffs, go up, therefore, that will be passed on to the consumer. There's no doubt about that. But if you have no federal income tax, is that really enough to offset this? Is that really enough to change the situation that we're in for the better for the American consumer? I'm not so sure. But then again, this is Chris's itty bitty baby brain talking. I don't know. But, keep in mind that Felix had recorded this video, which I really appreciate because I love learning, especially what's going on in the market. This is not my specialty, so this is why I like to find these videos and learn from them. This is before Trump basically said Nvidia is no longer allowed to sell chips to China. And so Nvidia is crashing this morning. It's going to be down about 7%. So Nvidia is going to open up around 104, which is all the way down here, right? Nvidia is going to not be having a good morning. And that doesn't help anything for AMD either, as you would think, oh, well, if Nvidia is selling off, right? If Nvidia is going to be down 7%, well, then AMD should be able to swoop in and take it, right? No, Nvidia also down 7% this morning. Why do we pick on Nvidia? Because Nvidia is a perfect example. Nvidia is the masterclass of what you shouldn't own. Nvidia is a masterclass of the stock you shouldn't own because it can't go further down from here. And yet somehow it continues to go further down from here. AMD does, right? Nvidia, somewhat in a similar boat, right? The stock that couldn't be beat, the stock that couldn't be broken is continuing to be broken for several months now. So yeah, let's see What does Nancy have to say about all this tariff and tax business? I don't know. She's, yeah, I'm at AMD. My bad. A whole decade? Wow. Yeah.
Mentioned seeing remarkable Republican unity. Whether that's wishful thinking or not, I don't know, but he's saying this is going to push these policies through. Now, the whole thing, though, forces the Fed into a reactive scenario planning mode. What do I mean by that? Essentially, Besant's strategy defines the two main possibilities that the Fed's outlined. If negotiations succeeds, see, tariffs are lower, which is the Fed's smaller tariff scenario. And if negotiations fail or reach a stalemate, higher tariffs remain in place, which is the Fed's large tariff scenario. The bridge between these positions is uncertainty. And that 90-day window represents the period of peak uncertainty for both the Fed and for you and me in our portfolio. Now, what we don't normally see is for the Fed to let.
Oh, and good point. When there is uncertainty, you can get out of everything, which is what I've done, which is what I've been preaching, and receipts are on YouTube. I've had no market risk for months now, many weeks at this point. No market risk at all as the market has been going down and down and down. Can you say the same? Can you actually sit on the sidelines and say, you know what, while the market is down year to date, let's find year to date. I'm gonna have to change my chart here. Let's look at the year to date. While the market is down, how much year to date? How much risk have you had on? Year to date, January 2nd was right here to here, right? So as of the close yesterday, down 8%. Its worst day had it down as much as 17% year to date. Can you say the same? Can you say, while the market is down, you've not had risk on? You've been risk off, right? How do we know when to go risk on versus risk off? Super easy with the outlier trend template. And Georgia knows all about this. I feel good. Nothing at stake since I met Chris. Yeah. This pullback right here, it's not unusual to have a pullback, but what is unusual is to know when to get out. And you're about to learn that right now. And it's only going to have you go to my masterclass, sign up for the masterclass down below, and I'll teach you the 3 simple steps. No, let's do that real quick. No, let's do that right now. So first, you want to have the 10-period EMA over the 20-period EMA with price over the 50-period EMA. That is a bullish trend. That is what I call the outlier trend template. Now, when they reverse, that is a bearish trend. Hands down, math, it always works. And it works on every time frame. I can go to the 5-minute chart and you can see a downtrend and an uptrend. I can go to the hourly chart and I can see downtrends and I can see uptrends, right? This always works because it's just math. So for me, I've been in cash for weeks at this point, and I've had no stress. And my portfolio is basically flat on the year. Can you say the same? Can you honestly take a step back and say, you know what? Maybe cash isn't such a bad trade when the market is crazy, right? When the market looks like this, let's do year-to-date map. Year-to-date map. When the market looks like this, where you've got stocks like Nvidia, which can't go down 16%. Stocks like Apple can't go down 20%. Stocks like Tesla down 37%. Stocks like Meta down 10%. How can Meta be good? No, it's one of those stocks that's always going to go up, right? No, down 10%, right? A lot of these names you've probably been invested in because you've watched other YouTubers talking about just what a great opportunity they are, right? I know a few others recently. It was like Sound, SOUN. Yikes. Give me a break. Or even something like Palantir. That's been a big one. But it's peaked and it's come down. Now it actually is looking a little bit constructive right here, right? Point is, you don't have to be invested all the time. There are times to be in the market. There are times to be out of the market. And right now, with the man sitting on his golden throne, golden porcelain throne, I don't know. Donald Trump sitting on the toilet, basically, having control of the entire world with his thumbs. That's where we're at this point. Politics aside, that is where we're at today. Donald Trump can sit on the toilet and change everything with a 30-second whim that crosses his mind. And because of that, we've seen markets crash and we've seen markets rally like gangbusters. Okay. You don't have to trade through all that. You don't have to go through all that. You can sit on the sidelines and wait for the trend templates to align and then go in. So let's continue on here.
Lay out their contingency planning in advance. They normally hold things quite close to the chest. So he's walked us through what they're preparing for. So let me walk you through it. There is scenario one, only two, don't worry. And you want to take notes because then you'll actually remember this. If Besson's strategy works out and we end up with lower tariffs, around 10% on average, the Fed can be patient. In fact, Waller suggested we might still see good news rate cuts later this year if inflation continues its gradual improvement. And the economic disruption will be manageable with only 10% tariffs. So we're still going to get some rate cuts second half of this year, which is good news for us because the stock market goes up when rates go down. Scenario two, negotiations stall and those high 25% tariffs remain in place. Well, this is where it gets dicey. The Fed anticipates a significant economic slowdown, unemployment climbing towards 5%. And despite the inflation spike, which could reach 4 or 5%, which they view as temporary, very important, let's take that down, their priority would shift towards preventing a recession, likely leading to faster and deeper rate cuts. And these would be what the Fed's Waller termed bad news rate cuts, responding to economic deterioration rather than to the inflation going up.
Okay, let's do this real quick. I want you to Google something called the CME Fed Watch tool. Google this. Then go to I think it's the first one here. Yeah, go to this. If you're ever like, oh man, I wonder what the Fed is going to do, don't worry. I got you. I got this. I got you. When I used to do consulting with financial institutions, I would pull this up with them all the time because they'd be like, oh, Chris, what do you think the Fed's going to do? I don't know, but I'll tell you who does know. The CME Fed Watch tool. Check this out. This is so cool. So today is April 16th. The likelihood of the Fed rate, so the current Fed rate is between 4.25, 4.50. The likelihood of a rate cut in the next few days up to May 7th actually is 14.8%. So there's a 15% chance that we have a emergency Fed rate cut. Isn't that crazy? There's a 15% chance we could have a Fed rate cut in the next couple weeks. Bigger than you expected, probably. What about in the next 6 months? Let's go to October. So these are the Fed meetings up here. Let's go to October. So current rate at 4.25, that's way up here. Holy moly. You're telling me that there's a 99.3% chance that we have a rate cut somewhere, any size rate cut in the next 6 months. That's pretty impressive. Pretty impressive, right? Like the majority says basically 95-ish, 93% says it'll be at least 50 basis points less than it is today. 95% confidence that we're going to have at least 50 basis points cut within the next 6 months. Isn't that cool? Isn't that interesting? I find that super cool. So yeah, CME Fed Watch tool, and it's free. It's free. But keep in mind, right? The old adage is that let's do this. Fed rate chart. The old adage is that the market, what does this go up to? Oh, this is current. Cool. That's what I want to see. Open image in new tab. Here we go. Oh, give me a break. Itty bitty baby image. That did not work like I wanted. Hang on. I want something that's fresh. I don't have to go on the Fred unless it's like perfect. That's perfect. Okay, sweet. So if you ever want to see like real economic data, you get it from Fred. Sounds weird, but it's true. So let's go to a 5-year chart. Okay, cool. This is exactly what I wanted. Thank you, Fred. So the old adage is as rates go up, the market goes down, or vice versa. When rates go down, the market goes up, right? When rates go down, the market goes up. So let's do a comparison side by side. So starting in March 2022, we've seen rates go up until September of 2023. So if rates are going up, surely the market must be going down. So March 2022 up to July 2023. Well, I don't know if you remember 2022. 2022 was pretty rough. 2022 was pretty rough. Actually, let's look at this on like weekly candles. Yeah. So 2022 is this time frame right here. Okay. So while rates were going up in 2022, the market was going down. That definitely was the thing. However, it bottomed around October 22 and then went up since that point. And we didn't stop cutting rates until a year later in September 23. Right. So this entire cycle here, you saw both. You saw market going down, you saw market going back up. But at the end up here, we're at 5.33% versus, basically zero. And what happened with the market? A slight pullback overall, 3% pullback. So we saw market rates go from 0 all the way up to 5% on the Fed funds rates. And yet the overall actual change between points A and B, a 3% pullback. That's pretty interesting, right? So when somebody says, when rates go down, the market goes up. When rates go up, the market goes down. That's not necessarily a perfect correlation. So that doesn't always mean, hey, you know what? If the Fed raises rates, the market's going to crash. It's not always a 1-for-1. I just want to give a little perspective on that.
And that is really, really odd. So they're basically saying we're going to tolerate temporary inflation up to 5% or so if the high tariffs remain, and we're going to focus on cushioning the economic downturn, which is a complete departure from their recent let's fight inflation in the trenches sort of approach stance. So what's the key takeaway? The Fed's path is almost entirely dependent on the outcome of these trade negotiations in the 90 days. So how's the market going to respond to this? Well, let's break it down. In the high tariff scenario, essentially negotiations fail. We're going to see downside in the market. Fear of recession is going to overshadow most things. Defensive sectors like utilities, consumer staples, and some healthcare names might outperform, which is why I've already shared them with my mentees on Monday. And then bond yields are going to fall as investors seek safety in those bond yields and they look for Fed cuts. And you're probably going to see me start buying US government bonds once again. And the US dollar, well, it's probably going to weaken a little bit. Now, on the flip side, if negotiations succeed, we get lower tariffs. There's potential for a massive relief rally. And the market's going to focus back on growth and earnings and all that kind of stuff. So your cyclical stocks will do well, your industrials and your materials, and then your tech companies will rebound. But note, in both scenarios, we get rate cuts, which if you have a medium to long-term horizon, means stock prices are going to go up. It's just a question of how much disruption do you get in the short term. So what's the savvy approach during this rather peculiar market period? Well, let me share with you my thinking. For the near term, I'd suggest being cautiously optimistic, but with a real priority on flexibility. You've got to watch out what is happening in politics there. So I'm focusing on quality stocks. I'm focusing on resilient companies. I'm focusing on defensive companies. I'm nibbling. My position sizing is significantly smaller than usual because I want to see how this plays out. Yet at the same time, I think there's some great opportunity.
And that's interesting because that's what we talk about too, right? The volatility has really picked up. The volatility has really picked up here. And because of that, you need to start having smaller position sizes. Now, my position size is 0, and that's just how I choose to trade. And there was a really good point in the chat. Let me find it. Hang on just 1 second here. Oh, here we go. Marshall 2.0. Why don't you just buy SH during a clear downtrend? SH, the inverse ETF, inverse of S&P 500 at a 1-to-1 ratio. My dude, by all means, if that is how you trade, go for it, man. That's what I say, right? If it's how you are set up to trade, go for it. Just not my trading plan. And that's okay too, right? Everyone needs to come up with their own trading plan. Don't listen to random guys on the internet and come up with what is going to work for you. Because I found what works for me, and sitting in cash for ages, that works fine for me. I'm not stressing on it.
So what are the criteria we look at? Strong balance sheet, strong pricing power, minimal trade exposure, defensive plays, essentially. And then for the more medium term, it's really just harder to foresee. I'm a little bit more bearish because I don't know what's going to happen. I don't really trust politicians all around. Now, I do think eventually we're going to get those tax cuts and deregulation. That could be towards the tail end of this year. And that will be very, very, very supportive. And I think then we're going to go more broadly again into a bull market. But if those negotiations falter, if the apparatchiks in Europe come out and say, no, we will not eat your American beef, that sort of thing, then it won't go very well. And then nothing will really happen on that front. And Trump's going to make him sweat because he's not going to cave in. I think that's the way this guy is wired. So again, I'd focus on sectors that are less impacted by trade frictions. That is utilities, for example. American utilities, well, you're still going to need water and power, and it's not impacted really by tariffs or certain healthcare stocks. Gold stocks I'm quite liking at the moment. There's a bunch of stuff out there you obviously need to do your research on and understand what the rules are. But very, very few people really know what to do in these scenarios, right? And that's why I always say, don't focus on the news, don't focus on the noise, focus on learning the rules, because the news and the noise.
Dude, I couldn't agree more. Don't focus on the news. Focus on your trading plan. Everything else is noise. Can you listen to it? Sure. But should you trade based on it? Absolutely not. Because I'm telling you, a lot of people, and some of y'all watching live, by the way, I'm not going to say any names, but a lot of people saw this 10% up move in the SPY, and they're like, oh, we're so back. And they FOMO'd into stuff to immediately get monkey hammered. Right? There is no mo FOMO. From this day forward, if you're watching the Outlier channel, no mo FOMO. Have a plan. Follow that plan. Lock out all the noise. You want to listen to the news? By all means, go for it. You want to listen to interesting random guys on the internet? Go for that too. But do not trade based on YouTube videos. Do not trade based on CNBC articles. Do not trade based on anything other than your trading plan. In fact, one of my mentors, you may have heard of him before. His name was Mark Minervini, probably the greatest trader of all time. He says, in fact, in his 6 key trading rules, number 1 is wait and cash for proper setups, for your proper setups, not somebody else's. Wait and cash for proper setups. How's long? As long as it takes. I embody that every day. I'm living proof of doing this every day. And in fact, let me show you my 2024 results here real quick. Why do you do this, Chris? Because it illustrates a point that you don't have to be active in the markets. You don't have to be all over the place doing anything all day, every day. In fact, what you should be doing is waiting in cash for proper setups. Now, these are following the Outlier 2.0 signals. Every single trade I took on here was an Outlier 2.0 signal. An Outlier 2.0 is about to be replaced by Outlier 3.0, and the signals are 3 times as good, if you can believe that. 3 times as good. I can't wait to share these with you. But you'll see, there were weeks at a time, where I did nothing. I only had 49 trades between May and December last year. 49 trades, that's it. And weeks at a time doing nothing until something happened, until my setup worked. Weeks at a time of nothing until my setup worked. Weeks at a time till my setup came through. Weeks at a time, and then I had a couple losers. November was my only losing month last year. I only traded 1, 2, 3, 4, 5, 6 out of 12 months last year. That's it. 6 out of 12 months last year, and I posted 91% returns with a 69% win rate. I mean, I think I did okay. Just about average, I would guess. I'm just joking. But now is not the time to be aggressive. Now is the time, like actually Richard has a great point. Now is a great time to paper trade. Learn your rules. Richard, perfect. Gold star, my friend. No mo FOMO, like Robert says. No mo FOMO, right? Come up with your rules, figure out what those are, backtest them. And when I say backtest them, what does that mean? Backtesting can be very manual. Very manual. That's how a lot of my rules came up, actually, was I got a signal, I go back and I'd say, okay, well, did this work in this market environment, right? What do I need to see in the market, right? Because it's not just your stock. There's a lot more to the market, right? 40% of your move is due to the market. 30% is due to the sector, and only 30% is due to the stock itself. So if you think your one stock is going to outperform everything else, I got news for you, buddy. 70% of its move is working against it. 70% of its move is working against it. So let's see what else Felix has to say. We'll wrap it up here.
Is useless to you until you actually understand the rules. So please, please, please do yourself a favor. Use the pain of the present market, and I appreciate it's painful for almost everybody out there, to sit down for 15 minutes, learn the rules, take notes, take screenshots, and then go and explain.
Yeah, with this masterclass again. Mikey Mike says, I've noticed that everyone who ever told me that the markets are efficient is poor. Dude, no doubt about it. So that came from one of my mentors, the very first billion-dollar hedge fund manager, Larry Hite. In fact, there were people who I used to follow that I do not follow anymore, and I cannot prescribe the way that they trade at all anymore. who would tell you that the markets are so efficient, so incredibly efficient, right? Just sell a call, and eventually your call will be out of the money, and you'll make all this money, right? It'll be so easy. I'm here to tell you, first off, don't sell options. Second off, the market's efficient, or the market is so inefficient. The market is so inefficient because they will tell you, hey, you know what? Markets are efficient. You can't predict markets. You don't have to predict them, but you can sure as hell ride a trend all the way up. And if you decide to, you can ride it all the way down. Tell me how the efficient market theory worked for Palantir right here. Tell me how the efficient market theory worked right there, right? Tell me how the efficient market theory said SoFi could go from $7 to $17 in the span of a couple months. Go ahead. Explain that to me. Well, that's a 7 standard deviation move, right? A 7 standard deviation move happens once every 54,000 years or something like that. But there's 2 examples. You could look at Palantir doing a move like that. You could look at SoFi doing a move like that. Once every 54,000 years seemed to happen really quick. There was a couple things in the chat here. Safi, what's up? I'm a noob. But when it comes to investing and trading, what are your thoughts on a Roth IRA and 401k? Watching your channel makes me think twice about VU and forget. First off, VU and forget, aka just buy the market. If that's how you want to trade and that works for you, go for it. Don't let me tell you otherwise. But there's a lot of volatility, right? There's a lot of risk that you can avoid. First off, Safi, super new here. Something that you should learn is that all stocks are bad, including VU, including SPY. All stocks are bad, but every once in a while they act right. SoFi, as an example, is a bad stock. Palantir, as an example, is a bad stock. But every once in a while, they act right. Tesla is a bad stock, and that's coming from a Tesla owner. Tesla is a bad stock, but every once in a while, it acts right. So keep that in mind, right? Now, Roth IRA, 401k, I'm not a tax guru. I don't know all those details, but I do know one thing. You can trade in those tax-free, my friend. Wash sale rules, don't worry about them. Everything is contained within the IRA. You're only going to pay taxes on, so a Roth, you pay taxes before it goes in. Traditional IRA, you pay taxes on its way out. But in the meantime, you can collect all the gains that you want to tax-free during that period. All the gains you want to tax-free inside of that account, which actually is very appealing. Very appealing. Because I see a lot of people who complain, oh, Chris, I'd love to do this. I would love to trade trends, but I don't want to pay taxes. Bro, first off, are you even making enough money to worry about paying taxes? Let's be honest, you're probably not. Second off, taxes are a byproduct of being a badass trader. And I don't know about you, but I would love to pay the mess out of some taxes if the byproduct is having so much more money in my account. So yeah. How much is a small loss? That's your choice. That's a great question, right? I always say there's 4 possible outcomes in a trade: a big win, a small win, a break even, or a small loss. There should never, ever, 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 ever be a big loss. Now, will some losses be bigger than others? For sure, right? We don't know necessarily how big of a big loss is for me or for you, right? But you need to figure out where your risk tolerances lie. And that I can't do for you. Let's see. ESAT says, breaking, U.S. stocks try to rebound as China says is open for talks if Trump shows respect. And then Jonathan says, no rebound. Red Pill Media, but all stocks get broken at some point for a period of time, right? Well said. That's exactly what I'm talking about, Red Pill Media. Yeah, all stocks are bad, and every once in a while, they act right. Tesla can only move like only Tesla can move like that. I see what he's saying here. Richard says, I get the 10 over 20, but it's a 200 play decision in making. It can for you, right? And this is why I never want you to say, oh, the only thing that works is what Chris says, right? No, I'm just a random guy on the internet. Don't listen to anything I have to say. But the 10 is the short-term moving average. The 20 is the intermediate term moving average. And the 50 is my version of a longer term moving average. So for me, that's what I'm looking for. The short term over the intermediate and price being over the longer term. That's what I want to see. Let me see real quick. Okay. So who else had some questions? No Fear says, no doubt SoFi is bad and people try to pump it up. Yeah, but every once in a while that's right. Every once in a while that's right. Palantir's looking sharper. Dude, it totally can look sharper. It totally can. And that's one other thing too, is that, you know, you see these YouTubers come out and they're like, oh, this stock is, you know, $75 in this one stock and it's guaranteed to go forever. No. It doesn't work like that. And you will see all the time, I say this constantly, trends change. Trends change. Trends change. It can trend down or it can trend up, but trends change. You need to be aware of that. Okay, so let's look at my exit signals real quick. By the way, let me introduce myself real quick. As a random guy on the internet, my name is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where Outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. So let's go up to my slide for exit points. So don't worry so much about here. These are profit targets using the outlier fear and greed numbers over here. We're not discussing that. We're looking at stop loss versus trailing stop. Okay, so let's go back to Palantir as our example. A stop loss for me is one line, and that's the half ATR from entry. We talked about how I calculate that. We talked about what that means. Now, a trailing stop is something that'll go along with you. So let's look at this side of Palantir for a moment, right? Let's do this side before it had that huge gap, right? Let's say, for example, I got in here and I put my half ATR here. And the half ATR point was not hit. We can all see this. And so the trailing stop moved along with me. And at no point in time did it close under the 10 EMA. Did it touch it a few times? Sure. Yeah, here's a great example of it touching. At no point in time did it close under the 10 EMA until right here. So this is what I would call a red light. Now, a close under the 10 EMA usually means something's not right. Something's not right. And you can see Palantir had this huge, beautiful move, hit the 10 and closed under the 10 EMA, and then went sideways for a minute from December until January 28th, nearly February. It went sideways. And then it had this giant move up after earnings. So you can kind of see when things are not going great. So 2 different ways to exit. First, a stop loss, but your stop loss can stay where it's at. And then your trailing stop will move up with you the entire way. I hope that helps. Steve asks, is the stop loss and trailing stop just lines on the chart? Just lines on the chart, my friend. But you need to know how to read those random lines on the chart from a random guy on the internet. Hey, don't forget, we are giving away a full year of Outlier and $1,000 to the winner of our giveaway over at outlierdeal.com that you can register for right now. We have already 7,863 registrants. How cool is that? Nearly 8,000 people have registered to get Outlier 3.0 for free for a year and a chance to win $1,000 with that. Now, first runner-up gets $200 worth of Outlier swag, like this incredible hat I'm wearing right now, and my 5 favorite trading book bundle. And then second runner-up gets $150 worth of swag and my 5 favorite trading book bundle. So if you are interested at all in winning $1,000 and this other cool stuff and a free of Outlier, be sure to go over to outlierdeal.com. And be sure to come back to this afternoon's live stream where Outliers like us will save time, make money, and start winning with less risk together as a team. YouTube is going to pop up a couple recommended videos. I recommend you watch them. I recommend you have a fantastic day. I'll see you this afternoon. Talk soon.